Wall Street lays on eggs. The bursts and bubbles are admittedly ancient history. Could the same sort of thing happen in sophisticated modern times? Let's turn to a more recent and familiar event from our own past and see. America, the land of opportunity, had its turns in the 1920s, and given our emphasis on freedom and growth, we produced one of the most spectacular bombs and loudest crashes civilization has ever known. Conditions could not have been more favorable for a speculative craze. The country had been experiencing unrivaled prosperity. One could not but have faith in American business, and as Kevin College said, "The business of America is business," and were liked to legalize missionarily and almost definite. Such analogies are even made in the opposite direction. Bruce Barton of the New York advertising agency Barton, Dustin and Austin write in The Man Nobody Knows that Jesus was the first businessman, and that his parables were the most powerful advertisements all time. Beginning in 1928, stock market speculation became a national pastime. From early March 1928 through early September 1929, the market's percentage increase equaled that of the entire period from 1923 through early 1928. The price raises for the major industry corporations sometimes reaches 10 or 15 points per day. The extent of these raises is illustrated in the table below. And not everybody was speculating in the market, as was commonly assumed. Borrowing to buy stocks, buying on margin, did increase from only 1 billion in 1921 to almost 9 billion in 1929. Nevertheless, only about 1 million people owned stocks on margin in 1929. Still, the speculative spirit was at least as widespread as in the previous craze, and was certainly unrivaled in its intensity. More important, stock market speculations was central to the culture. John Brooks, once in Golconda, recounted the remarks of the British correspondent newly arrived in New York. You could tell about prohibition, or Hemingway, or air conditioning, or music, or horses, but in the end you had to talk about the stock market, and that was when the conversation became serious. Unfortunately, there were hundreds of smiling operators, only too glad to help the public construct castles in the air. Manipulation on the market, exchanges set new records for unscrupulousness. No better example can be found than the operations of investment pools. One such undertaking raised the price of RCA stock 61 points in 4 days. An investment pool required close cooperation on the one hand and complete disdain for the public on the other. Generally, such operations began when 100 of traders banded together to manipulate a particular stock. They appoint a pool manager who justifiably was considered something of the artist, and promised not to double-cross each other through private operations. The pool manager accumulated a large block of stock through inconspicuous buying over a period of weeks. If possible, he obtained an option to buy a substantial block of stock at the current market price within a stated period of, say, 3 or 6 months. Next, he tried to enlist the stocks specialist on the exchange floor as an ally. Pool members were in the swim with the specialist on their side. A stock exchange specialist functions as a broker's broker. If a stock was trading at $50 a share and you gave your broker another to buy at $45, the broker typically left that other with the specialist. If and when the stock fell to $45, the specialist then executed the order. All such orders to buy below the market price or sell above it were kept in the specialist's supposedly private book. Now you see why the specialist could be so valuable to the pool manager. The book gave information about the extent of existing orders to buy and sell at prices below and above the current market. It was always helpful to know as many of the cards of the public players as possible. Now the real fun was ready to begin. Generally, at this point, the pool manager had members of the pool trade among themselves. For example, Haskell sells 2 shares to Sydney at 40, and Sydney sells them back at 41.8. The proceed in repeated with 400 shares at prices of 40 first 4 and 30 first 2. Next comes the sales of the 10,000 shares block at 40 fifth 8, followed by another at 40 third 4. These sales were recorded on ticker tapes across the country, and the illusion of activity was conveyed to the thousands of tape watchers who crowded into the brokerage office of the country. Such activity generated by so-called wash sales created the impression that something big was afoot. Now tips sheet, writers and market commenters commentators under the control of the pool manager would tell of exciting developments in the offering. The pool manager also tried to ensure that the flow of news from the company's management was increasingly affordable. If all went well, in in the speculative atmosphere of the 1928-1929 period, it could hardly miss. The combination of tape's activity and managed news would bring the public in. Once the public came in, the free-for-all started and it was time discreetly to pull the plug. As the public did the buying, the pool did the selling. The pool manager began feeding stock into the market, first slowly and then in larger and larger blocks before the public could collect its senses. At the end of the roller coaster ride, the pool members had netted large profit, and the public was left holding the suddenly deflated stock. But people didn't have to band together to defraud the public. Many individuals, particularly corporate officers and directors, did quite well on their own. Take Albert Wigan, head of Chase, the nation's second largest bank at the time. In July 1929, Mr. Wigan became apprehensive about these heights to which stocks have climbed and no longer felt comfortable speculating on the bull side of the market. He was rumored to have made millions in the pool boosting the price of his own bank. Believing that the prospects for his own bank's stock were particularly dim, he sold short more than 42,000 shares of the Chase stock, selling short in a way to make money if the stock price fall. It involves selling stocks you do not currently own in expectations of buying it back later at a low price. It's hoping to buy low and sell high, but it's reverse order. Wigan's timing was perfect. Immediately after the short sales, the price of Chase stock began to fall, and when the crash came in the fall, the stock dropped precipitously. When the account was closed in November, he had netted a multi-million dollar profit from the operation. Conflicts of the interest apparently did not trouble Mr. Wigan. In fairness, it should be pointed out that he did retain a net ownership position in Chess stock during this period. Nevertheless, the laws in existence today would not allow an insider to make short swing profits from trading his own stock. On September 3, 1929, the market average reaches a peak that was not to be surpassed for the quarter of the century. The endless chain of prosperity was soon to break general business activity has already turned down month before. Prices dropped for the next day, and on the following day, September 5, the market suffered a sharp decline known as the Babson break. This was named in honor of Roger Babson, a frail, ghostly, fictitious-looking financial ad, advisor from Wesley, Massachusetts, at the financial luncheon that day. It had said, I repeat what I said at this time last year and the year before, that sooner or later a crash is coming. Wall Street professionals greet the new pronouncement from the sage of Wesley, as he was known with their usual discretion. As Babson implied in his statement, he had been predicting the crash of the several years, and he had yet to be proven right. Nevertheless, 2 o'clock in the afternoon, when Babson's words were quoted on the broad tape, the Dow Jones Financial News tape, which was an essential part of the furniture in every brokerage house across the country, the market went into a nosedive. In the last frantic hour of trading, 2 million shares changed hands. American Telephone and Telegraph went down 6 points, Westinghouse 7, and US Steel 9 points. It was a pathetic episode, and after the Babson break, the possibility of crash, which was entirely unthinkable a month before, suddenly became a common subject for discussion. Confidence faltered. September had many more bad than good days. At times the market fell sharply. Bankers and government officials assured the country that there was no cause for concern. Professor Llewellyn Fisher of Yale, one of the progenitors of the instinct value theory, offered his soon-to-be immortal opinion that stocks had reached what looked like a permanently high plateau. By Monday, October 21, the stage was set for a classic stock market break. The declines in stock prices had led to call for more collateral from margin customers. Unable or unwilling to meet the calls, these customers were forced to sell their holdings. This depresses price and lead to more margin calls and finally to a self-sustaining selling wave. The volume of sales on October 21 jumped to more than 6 million shares. The ticker fell away behind to the demise for the tens of thousands of individuals watching the tape from brokerage houses around the country. Nearly an hour and 40 minutes had elapsed after the close of the market before the last transaction was actually recorded on the stock ticker. The indomitable Fisher dismissed the decline as a shaking out of the lunatic frenzy that attempts to speculate on margin. He went on to say that prices of the stocks during the boom had not caught up with their real value and would go higher. Among other things, the professor believed that the market had not yet reflected the beneficent effects of the prohibition, which had made an American worker more productive and dependable. On October 24, later called the Black Thursday, the market volume reached almost 13 million shares. Prices sometimes fell $5 and $10 each trade. Many issues dropped 40 and 50 points during a couple of hours. But the next day, Herbert Hoover offered his famous diagnosis: "The fundamental business of the country, blah blah, is on a sound and prosperous basis." Tuesday's October 29, 1929 was among the most catastrophic days in the history of the New York Stock Exchanges. Only October 19 and 20, 1987 reveled in intensity the panic of the exchanges. More than 16.4 million shares were traded on that day in 1929. A 16 million shares day in 1929 would be equivalent to more than a 3 billion shares day in 2006 because of the greater number of shares now listed on the New York Stock Exchange. Prices fell almost perpendicularly and kept on falling, as is illustrated by the following table, which shows the extent of the decline during the autumn of 1929 and over the next 3 years, with the exception of the safe AT&T, which lost only 3/4 of its value. Most blue-chip stocks had fallen 95% or more by the time the low was reached in 1932. Oh, I'm sorry for I cannot sharing the table. Okay, let's keep going. Perhaps the best summary of the debacle was given by Bertie, the show Business Weekly, which headlined the story "Wall Street laid an egg." The speculative boom was dead, and billions of dollars of share values, as well as the dreams of millions, were wiped out. The crash in the stock market was followed by the most devastating depression in the history of the country. Again, there were revisionist historians who say there was a method to the madness of the stock market boom of the late 1920s. Howard Beerman, Jr., example, in his books The Great Math of 1929, has suggested that without perfect foresight, stocks were not obviously overpriced in 1929 because it appeared that the economy would continue to prosper. After all, very intelligent people such as Irving Fisher and John Maynard Keynes believed that the stocks were reasonably priced. Bierman goes on to argue that the extreme optimism undergirding the stock market might even have been justified had it not been for inappreciable appropriate monetary policies. The crash itself, in his view, was precipitated by the Federal Reserve Board's policy of raising interest rates to punish speculators. There are at least grains of truth in Bierman's arguments, and the economists today often blame the sanity of the 1930s depression on the Federal Reserve for allowing the money supply to decline sharply. Nevertheless, history teaches us that very sharp increases in stock prices are seldom followed by a gradual return to relative price stability. Even if the prosperity had continued into the 1930s, stock prices could never have sustained their advance of the late 1920s. In addition, the anomalous behavior of closed and investment company shares, which I will cover in Chapter 15, provides clinching evidence of wide-scale stock market irrationality during the 1920s. The fundamental value of these closed-end funds consists of the market value of the securities they hold. In most periods since 1930, these funds have sold at discount of about 20% from their asset values. From January to August 1929, however, the typical closed-end fund sold at the premium of 50%. Moreover, the premiums for some of the best-known funds were astronomical. Goldman Sachs Trading Corporation sold at twice its net asset value. Continental Corporation sold at 256% of its asset value. This meant that you could go to your broker and buy, say, AT&T at whatever its market price was, or you would purchase it through the fund at 2 times the market value. Market prices were 2 or 3 times the inflation's value of their underlying assets. Clearly, it was irrational, speculative enthusiasm that threw the prices of these funds far above the value at which their individual securities holdings could be purchased. So, the last paragraph, and afterwards, why are memories so short? Why do such speculative quizzes seem so isolated from the lessons of history? I have no apt answer to offer, but I'm convinced that Bruno Branches was correct in suggesting that a study of these events can help equip investors for survival. The consistent losers in the market from my personal experience are those who are unable to resist being swept up in some kind of the tulip burgers quiz. It is not hard really to make money in the market. As we shall see later, investors who select a portfolio of stocks by throwing darts at the stock listing in the Wall Street Journal can make fairly handsome long-run returns. What is hard to avoid is the alluding temptation to throw your money away on short, get rich quick speculative binges. It is obvious lesson, but frankly ignored.